We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Oliver from Momentum Structural Analysis. How are you today, Michael?
I'm fine. Hi, Tom.
Great to have you here, Michael. You know, it's always interesting to check in with you from a momentum perspective. And in one of your most recent reports, you used the analogy of breathing, inhaling and exhaling as markets develop. So when markets exhale, how does that become more than a pause in either structure? And how does that become a new trend?
What we do at MSA is we look at short-term, intermediate, and long-term, especially long-term, momentum trends of major markets, foreign exchange, equities, commodities, gold, silver, and bonds. Okay. When I say look at long-term, let's say you had a chart of S&P 500, Nasdaq 100, the leading index. Okay, went up 16-fold between 2009, 2021, biggest bubble in history. Okay, when you plot it month by month, high, low, close bar on a price chart, you get one picture of the market. That's what everybody sees. Okay, and they draw their little lines on it and so forth. Sometimes the lines on price are valid. Quite often they're not. In other words, if everybody can draw the same trend line, then and it breaks, maybe it's just a trap. Gold proved that late last year when it blew through a floor, went another 3%, and then exploded back to the highs. So price chart breakout that didn't mean anything. Well, when we measure by momentum, what we do is we measure that price action in its relation to, in other words, how much above or below a given long-term average is this month's high and low. Mm-hmm. So, you're X number of points above it or below it, and then you close. And so you plot it as an oscillator. And when you plot it that way, momentum-wise, using, let's say, a long-term metric like a 36-month average or a three-quarter moving average, you get a different picture. Which you look at the price chart, but when you look at that momentum chart, you quite often are going to get a different chart picture with even different trend lines on it. Maybe clearer floors, clearer ceilings, clearer multi-point trend lines. And you look at the price chart and you can't find those structures, but on momentum, usually you can. We've found, and we've been doing this for 31 years now, that when momentum breaks a very clear trend structure, it's usually valid, and it usually will indicate a trend change before the price chart will tell you the same thing. So you get some heads up. In other words, the momentum tells you, oh gosh, there's this trend structure. If I drop to X number of points over the 36-month average, I'm going to blow a 5-year uptrend. Okay. And you look at the price chart, you can't see it. But momentum says, uh-oh, you broke something. Okay. Well, in January of 2022, we broke enough things on Nasdaq 100 and S&P 500. We're talking a year and a half ago almost, to say, okay, that's likely the top. And your annual momentum says, I'm now going into a negative direction. Usually in a bear market, in stock market, you don't begin with great speed. They did in 29, that's the rare exception, but even it had a 50% rally back to the high. Usually the first leg down is arm wrestling, where it's confusing. Boy, it's confusing today, right? Everybody, oh boy, look, it's all good again, and et cetera, et cetera. Our long-term momentum analysis of the stock market says, from an investment point of view, I don't mean month to month. I mean, you can get some trading swings that go up and are nice and enjoyable, and you maybe even participate. But don't let that confuse you. A lot of damage was done early last year, and it was exposed in the June drop and then again in the October low. So from a momentum perspective, we see a different thing than what you do when you see a price chart.
So Michael, you use the example of the NASDAQ there, and we've really seen, I saw a chart yesterday, for example, on Twitter, that this is the best start to the year that the NASDAQ has had. Does the concentration of, let's say, market participants that are leading that charge say anything about the health of that move?
Yeah, it's not broad. We know that. Last few weeks, I think some of the broader indices have had some upticks, but they're minor. Okay. If you analyze the action since the October low, remember we made a low in June for the S&P and made a marginally lower low in October. Same with the Nasdaq 100. And since then, you've had a very protracted rally. A lot of it's been overlapping where, where you go up for 4 or 5 weeks and pull back, and you go up and you pull back, and so forth and so on. We view that as a counter trend rally, counter to the negative that was generated over a year and a half ago. Yes, it's legitimate. We've been positive on the S&P and Nasdaq in terms of intermediate trend, meaning what might happen over the next handful of months. Okay, and it's happened. It's gone up. But when you look inside, like you just said, you'll see it's about 5 stocks or 6, where you can take those 5 or 6 stocks that are so heavily weighted in the S&P. Like, about 5 or 6 of them constitute like 30% of that index. Well, there's 500 stocks in the index, quote unquote index, okay, that explain the entire move. And in the Nasdaq 100, those same 5 stocks constitute closer to 50% of the index. So to some extent, it's sort of silly to call it an index. It's really, an ETF of 5 stocks, okay? That's extremely narrow. It's happened before, but rarely this concentrated. And so what it does, it causes people's heads to turn because they see the S&P, quote, 500 doing something, and the Nasdaq 100, the best start to a year ever. Well, but when you take, let's say, 80 or 90 stocks out of the Nasdaq, you can explain it with, less than 10 stocks, explain the entire move. So what does that tell you? Well, you better watch those stocks. It's one of the things we do week by week is we focus in on Apple and Microsoft. Like in the last weekend report, we even included NVIDIA, which is a fairly weighty stock as well now. And our assumption is this, and we're joking about it, but we're not. If you can define the downturn in those stocks, you don't even have to look at the rest of the market. They'll take the market back down. Mm-hmm. Okay. And so I think you can actually just focus in on even Apple and Microsoft would do it. And it's something interesting about them because they both went up and made a, quote, new high. So if you go back a year or so, you'll find a prior high, and they both marginally took it out by enough so they could beat their chest, and you'd have a headline, new high in Microsoft, new high in Apple. Okay, let's see it then. Let's see if that new high leads to something, or instead it was a teaser, and over the next few weeks, you start to fade back down. And it won't take much to start that. And if that begins, that's when we get real focused on those stocks, breaking significant enough structures on momentum to say, okay, it was a fake out. Mm-hmm. Okay.
Going through one of your other reports here, I saw that you used a point and figure chart that didn't use any price movement less than $50. So does that help you, take out a bunch of the noise from the price charts to be able to analyze what the behavior and let's say the psychology of those markets and market participants are doing?
Well, that chart was a gold chart. Mm-hmm. And what we did is, if you go back to 2020, the summer high, the top $50 tick was $2,050. Didn't touch 2,100. Okay. Then you fell back down to 1,700 area. You went back up in March of 2022 and hit 2,050 again, not 2,100. So you put upticks on the point and figure chart. You left a double top. Okay. Spread apart, but still a double top. Meanwhile, below, you set up a double bottom at 1,700 because you had a couple pullbacks in between those highs. It got you down ticks to 1,700. You never went to 1,650. Okay. So you had a box, perfect little box, 2,050, 1,700. You went down last summer, fall, and took out the low prices that constituted the bottom end of that box. Actually, the low price was about 1670s each time, but it went down enough to hit 1650, put in a triple bottom breakout on a point and figure chart. Again, we're talking price. So if you're a point and figure guy, and we're not, but we respect the chart, it somewhat takes away the noise because you don't enter upticks or downticks, new downticks on that chart unless you've had at least 3 block reversal. So you ignore anything less than that. So if you don't get $150 swing the other way, you don't even acknowledge the move. Okay. You went down enough and you blew that low out, got to 1650, put one tick below the triple bottom. And from an orthodox point and figure point of view, that's a sell signal. Okay. And if you look just at a price chart, a bar chart, you'd say, oh, it broke the floor. It's going to 1200. All kinds of swing measurements were created. And I saw every report out there that was bearish, even gold bulls. We said it was a bear trap. What you did is you then went from 1650, you went to 1750, 1800. In other words, you aborted back up into the box and you zapped to the top of the box by February, March of this year, back to 2050. Okay. So what had been a perfect box and you blew the bottom out of, you're now at the top of the box. And so far, you've yet to put down ticks in. In other words, we've had 4 to 5 months of constant selling in gold. And we're spinning between 2050 and 1950, made lows at 1920 something last week and 3 weeks ago about 1930. The general rule of a point and figure box like that is if you blow out one side and it turns out to be a trap, if you go back to the other side, it won't be a trap. It'll be valid. And so we're pushing at the top of the box, but rather than break through, we like the fact that gold has paused. The reason we like it is it got overbought, going from a 1613 price low all the way back up to 2050 plus in like a straight line. Well, there was some zigzags, but not enough to put down ticks on that chart. To go all the way back up there, you got overbought sort of on an intermediate basis. Your momentum indicator said, gee, boy, I'm too hot to handle. Okay. So it cooled off. By now, it's been 4 to 5 months of spinning around in price, and momentum readings have cooled off. So now, if you go through that 2050 level, and let's say tag the 2100, which then will wake everybody up, you won't be overbought because you just spent 4 or 5 months cooling the market down. So I like the fact that it paused because it means if you do go through there, which we think it will, it won't be overdone when you do it. It'll be fresh air in the lungs, ready to go. So it's a very interesting chart. And we strongly argue that it's likely to put that next tick in 2100. And at that point, you get a gusher in terms of the dynamics of gold and the related markets.
Mm-hmm. One of the other, I guess, notes that you had on that report was when these moves end up staying at these levels for several months, that starts to indicate that trend really wants to break one way or another after that sideways consolidation. So does that kind of bring in, let's say, going back to what we were discussing about the difference between momentum and price charts, that bringing back of these moving averages, that lets the price analysts kind of come back into view with that confidence as well, does it not?
Yeah, and you might even, there's a lot of very popular averages, and there's no moving average that's holy, believe me. In other words, the 200-day average or the 50-day or the Wall Street Journal uses 65-day, which is a 3-month average, about 65 trading days in any month, 3-month period. Those averages, sometimes a market will pause at them and use them as support or resistance. But quite often, when you get to a very popular average, the market will tease you. Like it'll pull back to its 200-day average, let's say. And if it breaks under it, don't scream, because you need to look back at that market to see what its behavior has been like compared to that average over time. Because you may find when you look back at, it breaks it all the time. Mm. And quite often it doesn't mean anything when you break below the 200-day average. You go for another week down and then you turn back up again. You make fools out of people who believe in such numbers. Mm-hmm. Quite often, the momentum trend structures that we look at aren't coincident with the moving average itself. In other words, let's say you pull back to what's called the zero line or an oscillator. Let's say it's the 200-day average, okay? And you find that if the market before has come down to a zero line, 200-day average, and held it and bounced, then it breaks it, that might be meaningful because you're breaking a structure. But if you haven't been to your 200-day average in eons, and you finally come down to it and break it, it doesn't mean much unless you've built the structure there that shows up on the momentum chart as a repeated use of that mean, that average. as support or as overhead resistance. So right now, so far, the pullback in gold, it's just wheel spinning. In fact, you can look at a price chart, and I suggest everybody do this. Punch up a monthly close only price chart of the nearby continuation chart of gold. Ignore the intra-month stuff. Just look at the monthly closes. You go back, you'll see this huge surge in 2020 and a very, very gradual downtrend line across the 2020 peak close, 2022 peak close. And it was a rally high in January of this year that hit that same line. There's even on a price chart where the gradually almost flat downtrend line. Then you backed up into March. If you recall, there's a serious sell-off in gold and silver. And then you blew through it by the March close. Since then, the closes, if you plot them on a close-only chart of gold, are merely dancing around above that line, sort of going inhale, exhale, inhale, exhale. Nothing's going on, even on that price chart, which looks positive. So, if you're in gold, you've got to, take a deep breath, expect the downticks. And we argue that there's going to be some point probably this year where you're going to see moves in gold and silver that are so dynamic that you may get $2 down days in silver and $100 down days in gold that won't mean anything. Will be so dynamic at that point that after you had to have your $100 down day in gold, 2 days later, you go up 200 more, where the dynamics really take over. Mm-hmm. So get ready for that. Anyway.
You're mentioning, Michael, these high ticks that we've seen, August 2020, March 22. What was the difference between those two and this previous one, in let's say February, March of this year?
Well, coming back to those same price levels again on the point and figure chart, it already tells you something. It says, hey, I fooled you down there, taking out the lows. Now I'm back. I'm ready to take out the highs. And usually when you go back to the top of a box like that, that's the intent. You're gonna go through. It's highly unlikely you're gonna fail there and go back to 1600 or something. I think that all we've seen since then in silver, in the case of silver, it's slightly different, by the way. Silver made a high at $30 back in, actually its peak was in early 2021. It made a high in summer 2020, just short of 30. And then in early 2021, it traded over 30. Okay, so there's your high. In March of 2022, when gold was back to its high tick, silver had its high weekly closes just above 26. Okay, remember that number. Then we dropped all the way back down after the March 2022 high and traded down almost to $17. And then quickly, you're back up to, I think, 23 or so, and then had a pullback. And then you reached 26 over the last few months, pull back a bit, back to 26 again. In other words, the recent highs in silver are sort of doing what gold did. It's gone back to a prior high, in this case, the March 2022 high. Just look at a weekly close only chart. And we've had weekly closes recently up there just above 26, just like we did in March 2022. So even the price chart on silver, forget the momentum, has defined a ceiling that when you go punch back, we argue you even see $26 again, get out of the way if you're a bear. Because it's set up a triple top there as well to blow through and make it a triple top breakout. So they both set up the same kind of structure. And I think all they're doing is wheel spinning to cool themselves off so that when they do go through those structures, they've got the dynamics to really go somewhere, as opposed to already being tired when they do it.
Mm-hmm. So, Michael, do you take into account other markets like, let's say, the dollar strength, for example? Many analysts point to the dollar's, absolute level as an explanation for gold's related performance at the time. So do these correlations have strength from your point of view?
No, yes and no. We got very bullish on the dollar in the low 70s. No, excuse me, and they did with the upper 70s back in 2012. Dollar index we're talking about. We thought it would go to 100. It took it till early 2015. That's, in other words, from mid 2012 to 2015, it went to 100. It's a pretty big move for the dollar. If you look at December close in 2015, where the dollar was, it was just below 100. It was like 96.70. Okay. Keep that in mind. Gold was at its low at 1,050 area. Okay. The dollar index, if you plot it since late 2015, has been in a range of about 12 to 15%, mainly about 12% range, up and down and up and down and up and down. And during much of that time, between 2015 and 2020, well, the dollar had moves up and down with a high like at 103 something and a low back just barely under 90, back and forth, back and forth. In other words, sideways. Gold doubled in price. So if you looked at the dollar to explain why did gold double from late 2015 to mid 2020, the dollar doesn't explain it. Okay, now, last year, the dollar in March or so of 2022 zoomed through the top of this box that it had, where it kept making highs in early 2017 and again in 2020, up at that 103 area. Okay. Blew through there and went to 115. Everybody thought, oh boy, party's on. Of course, they weren't looking back 30 and 40 years to see what the dollar had been then. It was 160. Okay. So we're dealing with something in the hundreds, low hundreds. It's a descending pattern over a long time. Okay. But anyway, it had its breakout. And then when it pulled back below 111, we put out a sell signal and it dropped rapidly down to just below 101. Rallied up to 105. So that's a 4.5% rally. 105.5, actually. It's February, March of this year. Back down to 101 again. Then up to 104.5. Now we're back down to 102 area. So the dollar's been in a tight little box, but after a collapse from that spike high at 115. So just like gold has spun its wheels after a run up for the last 4 or 5 months, spinning its wheels, the dollar index collapsed from 115 down to above 100 and has been in this 3.5 to 4.5% range for 4 or 5 months now, going nowhere, just spinning its wheels. I think it's been cooling off just like gold has, so that when it does break down through this price chart level that everybody's playing, this 101 level, there's going to be a lot of upset folks who've been buying the same level over time. We've got some trigger numbers down around 100 such that if you hit it, you're going to have a mini collapse. And we think if you even get back to 101, you're highly unlikely to hold it. And again, our recent low has been just above 102 a few days ago. So we're not far away. And it's been wasting time. So therefore, does the dollar matter? Yes, I think now it probably does on an intermediate basis, because gold and the dollar are behaving almost precisely the opposite. And the dollar has not impressed us at all. I mean, the biggest rally it's had been 4.5% rally since that collapse. And now we're 1% from the low. So if the dollar sinks through that pattern, I think at that point, the foreign exchange market, especially the major foreign exchange, which have been, like I described, in a 7-8 year wide range with a fairly narrow max to low, okay? If you unquiet the major foreign exchange markets, they'll suddenly become a factor again in the overall market scenario. Foreign exchange has not been a dynamic factor. It's been a sideline factor that has not generated headlines because the moves haven't been huge. But if they suddenly get violent again, and we think the dollar going back through 101 will do it, then suddenly you're going to have a new variable that impacts the stock market and, of course, gold. How would it affect the stock market? Many of the investors who've gotten in the U.S. stock market over the last several years were foreign. Why? Because frankly, if you compare the S&P and the Nasdaq to, let's say, the European exchanges, we beat their pants off compared to the gain of the last, up to 2021. We were far, far out in front of them in terms of percent gain. So a lot of foreigners invested in the U.S. market naturally. Well, of course, they've been losing money over the last year, just like everybody else has. But if suddenly the dollar starts to weaken and becomes a percentage factor in their portfolio's value, not just the value of the stocks, but the underlying dollar when they convert it back to euros, for example, then that's going to motivate them to evacuate the U.S. markets because they're losing money on the dollar side of the equation and they're losing money on the stocks as well. So that further exacerbate a stock decline if the dollar weakens more. So it could become a big domino that isn't in play right now, and I think it's about to.
Yeah, it seems like such a complicated picture to try and understand from the fundamental side of what's going on with the dollar index, considering the ECB, their strength and weakness, all of these different factors of people running to the US dollar for safety in times of uncertainty. It kind of makes your head spin trying to put all those pieces together. So, going back to looking at just the chart seems to simplify it, right?
Yeah, even on the price chart of the dollar now, you can see vulnerability pending. You understand why they bought it here in the 102, 103 level for the last since February, after the collapse from 115 down to under 101. Okay, very rapid collapse, by the way. You gave back all the gains in 2022 in a matter of like 3 months. Okay, that is you can look at a price chart and you can look to the left and you say, oh, I see why they're buying it there, but it isn't working. In other words, if you bought it there in February, yeah, you had a rally to 105.5, and then you had a rally up to 104.5, and now you're at 102. You're not making any money. Okay, you're wasting your time. And if all of a sudden that reality dawns on the people who've been buying the dollar for the reasons you just expressed, which used to be the reasons, okay? But think about it this way. The world's changed dramatically in recent years, especially with the emergence of crypto, okay? Why in the world do you need a global reserve currency? I mean, I understand, in the old days when ships sailed the seas and they communicated with telegraph and so forth, British pound was the global currency, okay? And then it evolved to the dollar. But in this day and age, when a corporation or a government can in any microsecond change their position in Forex markets at almost no cost by pushing a button and shifting from X currency to Y currency and back and forth. And, if they're uncertain or concerned about something, they can shift it. They don't have to mail a letter to somebody, it takes a week to happen and costs a lot of money. It's something that can happen electronically, and it's global. And we're all wired together. So why there should be one, quote, monopoly currency that everybody cares about, that should slowly evolve out of the way. And I think it is. And, whether the Chinese come up with their, alternative thing, the other side of the world thing, whether that succeeds or not, which they're trying to, and it may succeed, but at least it undercuts the dollar. But why there should even be two, I don't know. I think the evolution is such that we don't need that. So the concept should go out the window. We're an electronic world now. And I think that ultimately will erode that notion.
One of the other markets that obviously, spurred the US dollar being so important was the oil market, facilitating trade within the oil market. So, again, stepping back to try and understand that market from a fundamental level with OPEC's cuts, Russia's oil basically being taken off some of the market. How does the oil picture look from the chart perspective here?
Well, just technically speaking, in October of 2020, MSA put out a report called Commodity Explosion Coming. Price of the Bloomberg Commodity Index then was around 70. Its bear market low had been in the high 50s, okay? Now remember, it was 70 at that time, October 2020. Gold had already doubled in price and commodities had stayed under pressure from 2015 to 2020. They'd been capped off with a slightly descending pattern at price levels we called theoretical zero. Okay, I'm talking everything, grains, base metals, energy, and so forth. The first leg up that carried to February of 2022 doubled the price of the Bloomberg from 70 to 140. And it all occurred before the Ukraine event ever happened. Remember, that was February 2022. Well, heck, commodities had already basically seen, or were near their high at that point. Okay, so when that war started, commodities were basically topped out. So they didn't go up because of that event, like a lot of people like to rationalize away. It's not because we printed money, it's because of that war. Okay. During that market move, energy did lead the move. Percent-wise, the best places to have been were natural gas and crude oil. Yes, everything else went up. But percent-wise, those were definitely the leaders. Now, since then, both energy, especially natural gas, has collapsed. We had a target of $9. It got to 10. Okay. It's collapsed back down to 2, which historically is pretty low. Okay. So it's overshot itself, we'll admit. And it's done some damage in the process, obviously. Crude oil has pulled back big, but so have the grains. A lot of commodity markets have pulled back. The Bloomberg pulled back from a high monthly close at 131. Its high trade was 140 in 2022, but its high monthly close was 131. Remember that. Okay. We've pulled back to just barely under 100. Right now, trading about 104. So we're about 4 or 5 points off the recent low. We think if you close the month around here, you're going back up again. It indicates to us. But forget that. We've analyzed within the Bloomberg Commodity Index various sectors, energy sector and the foods. Now, when we look at that and we measure them as a relative performer to the Bloomberg, just like you would take a stock market and look what sectors are outperforming the market, okay? It's clear to us that the ag sector is now the leader. In fact, there's an ETF called DBA, which is an ETF only of the agricultural related commodities: cotton, cocoa, coffee, sugar, and the grains and the meats. Okay. Not the base metals, not the energy. Okay. When you measure it versus the Bloomberg Commodity Index, it's on a spread basis. When you plot the spread chart, month to month close, what's their relationship? It's broken out. Did it a couple months ago, in fact, favoring the ag components. So in this next leg up in commodities, which we're going to get, we think it's going to be the food-related commodities, not the energy-related. Oh, they'll go up too, but I mean, I don't think on a percent basis they will match what the foods and the ag commodities are doing. Already sugar is terrifically strong. Mm-hmm. And, you know, everybody says, well, we don't need sugar. Well, you do. It's on every box. You go to a grocery store and flip over the ingredients, you see sugar in there. Okay. So that's where to be. So when you ask the question about energy, yeah, I think it's going up with the Bloomberg. And by the way, we got a number in the high 103s. If you can close the month out on the Bloomberg above that level, we think you've broken the intermediate downtrend, which has been corrective, and you're headed back up again. But when you look at that DBA, it's trading almost at the high monthly close that it made in 2022. So the agricultural components, well, the Bloomberg's high was 131. It's trading 103 or 104 right now, rather. It's got a ways to go to get back to its high close. The DBA is trading right at or just decimals below its high monthly close of 2022. So even its price chart is telling us it's a stronger component. So energy is not going to be the best place to be within the commodity category, we don't think. We think it's going to be more, in a way, more sensitive. Food.
So do you take into account, like when you're talking about energy, that energy component of the Bloomberg, do you take into account uranium? You know, it's had a bit of a move up lately. So what type of a momentum signal do we need to see for confirmation of a new uptrend in that?
Well, uranium hasn't really even corrected. It's just paused. Mm-hmm. So of the three, you know, natural gas, oil, and uranium, we got bullish on uranium, gosh, 6 months off its low several years ago. And frankly, there's not been enough pullback in it to cause us to alter that view. There was enough pullback in oil and natural gas for us to say, oops, they're broken. They're going to be under pressure. Mm-hmm. And sure enough, they have been. And we think they're probably through with their downside, but they've been under serious pressure. Uranium has been basically picking its teeth up there, you know, more or less like this. So it's behaving quite well. And, you know, that may be indicative of the world making a transition, which makes sense, toward, you know, with the French have been 90% nuclear for years, you know, it works. So it's behaving well, uranium. So in other words, there's an ETF for that, by the way, of the major producers, URA. Also Cameco, which is the largest CCJ, largest producer of uranium in the world. It's publicly traded. Those are areas we'd look at as well. So in the energy sector, we would segregate out uranium because it's behaving better than oil and natural gas. Yeah.
So Michael, do you ever look for markets that have, you know, a clear and possibly dramatic breakdown to invest in? You know, taking something like the March 2020 lows in many markets. Are there points where you see a waterfall event like that on a chart and think that creates a large opportunity for you?
Yeah, mostly the ones we see now are upside gold and silver, but they've already crossed most of our momentum numbers. The main thing left on them now is the obviousness of price, namely that triple top breakout on gold getting to 2100 or silver getting above 26 again by a significant amount. Forget them. We look within the stock market because at any given time, various sectors are beating the market or underperforming the market. And there's one sector, the financial sector, the broad financial sector now, not the banks. Back in January, late January, we put out 2 reports on the banking sector. At that point in time, the banks were looking really good. They didn't, when S&P made a low in June, Nasdaq made a low in June, rallied, and then came back and took it out in October. The banks didn't. The bank ETFs did not take out the June low. Instead, they double bottomed there. And they went up into January. And in January, we put out a report. We said, watch out for an ambush in the banks, even though they were looking good on price charts. And the reason was a momentum-based, we could see a pending structure. They broke that structure about 5 or 6 weeks after that report and crashed. And you took all the bank sector ETFs, the regional banks and the bigger bank ETF, KBE, through the 2022 lows. And they're wheel spinning way below those lows right now. So the banks are broken, even on the price chart. You look at them. It'd be like the S&P trading right now at about 3,000, okay, if they match the banks. But when you look at the broader XLF, which includes some banks, but mainly other financial institutions, asset managers, insurance companies, so forth, credit card company, American Express, it has held its 2022 lows. While the banks went through. Those lows are either side of $30 on XLF. We get down to 30.30 in March. Since then, it's rallied back up to 33. And when you look at a price chart of XLF compared to the S&P, it'd be like the S&P going back down to 3,500 or so recently, but not breaking the lows of 2022. And rallying back up to 300 points or so off that low. It wouldn't be anywhere like what it looks like now. If the S&P were matching the XLF, one looks lame, the other looks, oh, look at me, I look great. Of course, that's because 5 stocks. We're watching XLF because if the financial sector starts to break beyond the banks, we're talking now, American Express, Visa, insurance companies, and so forth. If they start to break, then the simplistic notion that, oh, it's a couple badly managed regional banks goes out the window. Because then people realize, oh, heck, this is broader than we thought. But then there's the other sector that we really see a potential ambush in. And this is based on annual momentum of the XLV, the healthcare sector. If you look at healthcare, that ETF, compare it to the S&P, it went up into 2022 highs, 2022. And it peaked there, just like the S&P. When the S&P dropped back 25% or so during 2022, it only dropped back, 10% or so, and has actually gone back near its high again. So when you look at XLV, it looks like a market that's gone to sleep in a range not far from its high. Now, we hold open the possibility you might want to spike that high in the XLV, and we've given them the opportunity to do it in the recent rally, but it hasn't done it. It's starting to act anemic now. When we look at annual momentum of XLV, it has what we would call a crash structure below it. Meaning, if you go back to 2009, when it emerged to the upside with the broad market, every pullback in the healthcare sector, XLV, stopped at its 36-month average. That's a smooth 3-year average. It's an average most people don't look at, but we adjust it monthly. What's the 36-month average? It has used that thing like 3 times as support over the span of that dozen years. So when you look at a price chart, you don't see this floor. When you look at the annual momentum, you see a floor that's been used and used and used. It won't take much of a drop, percent-wise, from where XLV is now to blow that floor. And when you look at a price chart, the level it takes to break that momentum floor doesn't really scare you on the price chart. That's the way we like it. Whereas we like when momentum says I'm in disaster shape, and price says, oh, I'm looking good. Because that's when you ambush people. That's what happened with banks. Price chart looked great. Momentum said, nuh-uh. So the one sector that nobody's talking about because it feels so good is the healthcare sector. By the way, it's a heavily weighted sector too. It's like 14% of the S&P. It's even more than the broad financial sector. So short of technology, healthcare is the second biggest sector. So that's a level we would watch. So there's one that we would say, yeah, there's a pending ambush out there. And it's just a matter of monitoring because every month that 36-month average adjusts up about a point or so, such that as long as the XLV continues to hover, the breakage point rises up under it. So it wouldn't take much to break it. So that's another sector we'd watch for a surprise situation. And surprises and ambushes are the best places to be because usually it's quick when it happens.
So, Michael, in this environment where, we see this sideways wheel spinning action, let's say consolidation in the metals, for example, do you hold positions in general ETFs versus the miners and then wait for a clear signal from the underlying commodity before wanting to look at the miners?
Yeah, I think it's best when you look at the miners, which are very weak compared to gold. Historically, they're very weak. But whenever there's always a period in a gold bull trend, if you go back and look historically, where the miners suddenly beat the pants off gold. And usually that occurs when it's become so obvious to the price chart watchers that, oh gosh, we missed it. The doubters in gold that have accumulated over the last 2 years, 2.5, 3 years in gold, the doubters, the gold bears, and the gold bulls that have gone tired. Okay. Once you reignite their interest and slap them in the face with the reality that, hey, you were wrong. This is really a bull and it's going somewhere. They're not going to go out and buy bullion or futures. They'll probably buy the miners. And it's that point probably where you're going to see the miners suddenly snap the other way. Instead of underperforming gold, they'll rapidly shift to an outperform status. And gold might go up, 30, 40% in a given period, and they'll go up 200%, 300%. This has happened repeatedly during gold bull markets at some point in each bull market, not necessarily from day one to day A to Z, but at some point in those trends, there's a point at which asset flows move into the gold miners. There's another thing that could help the gold miners, aside from gold's behavior, which is what you got to watch. If you own the miners, watch gold. Pay attention most to the mama market, okay? But portfolio managers, even if they don't like gold or gold miners, if there are other alternatives sour on them, and last year everything was sour. Bonds were down 30%, Nasdaq down 30% plus, S&P down over 20%. Silver up 2% on the year despite its gyrations. Gold's 2022 close versus 2021, unchanged despite its gyrations. So of all the assets out there, if you're a major portfolio manager who can diversify into those categories, you're basically forced to say, hey, if I'm going to stay even, I got to own those things. I've got to shift to the things that are behaving better. If all of a sudden they start to beat the market and the market starts to sour on you again, the stock market, let's say, where all the hope that we see now goes out the window because, oh gosh, the S&P just rolled over again. Oh, the financials just took out the 2022 low, et cetera. That's when you get another shift wave of money that leaves that category. It has to go somewhere. Mm-hmm. And if it goes into gold and silver, a lot of that money is going to also look down at those miners and say, boy, those are cheap. Boy,
looks like
those
a hell of an opportunity.
Good. Yeah, look at the earnings, wow. And anybody who does the historical studies will say, yeah, and these guys can snap big time upside. And I think that's when suddenly you see something that's really weak and limp get real strong. And that's where I'd look for the miners to suddenly snap and go the other way. Mm-hmm. The other thing we do is we run spread charts, meaning we measure like GDX in relation to gold and plot its relative performance. And of course, it's been in a downward pattern for the last couple of years, ever since that summer 2022 high. When, by the way, miners beat gold then during that run up in 2020. And since then, they've retreated more than gold. And while gold's back at its highs, the miners aren't. They're only like halfway back to their highs. So you can see on a price chart, they're much weaker. But we plot a spread chart, and quite often we can identify a point well before the miners ever get back to their old highs. And therefore, at the same, where gold is back near its highs, where the spread says, okay, I'm returning to an outperformance status. And that's another thing we watch, is that relative performance of miners versus gold. And quite often we can identify that before it becomes evident on price. Mm-hmm. But again, that's a sector that's so small with such good earnings that you get gold going again above its old highs, for example, and you get that stock market to lose sentiment. That's when I think the miners will take off.
Michael, to kind of wrap up here, we're getting into, let's say, the preliminary parts of the next election in the US here. And the markets typically don't like uncertainty. And I don't know that there's ever been a time with more uncertainty here. How do you think that factors into, let's say, the next 18 months for the markets?
Mm-hmm. I don't think it's been factored in, but it should be. Mm-hmm. You turn on CNBC or Fox Business and you don't hear them talking about election potential outcomes, primary outcomes as a variable that will affect the stock market. It's not being discussed. It will be at some point. Standing outside the entire arena, not having a view favoring any of them, okay? Here's what I see. Trump has 35% of the GOP, and this is a statistic that many pollsters think is solid. He owns a third of that party solid. He could create his own party tomorrow, and they would follow him out of the party and go with a third party, okay, if he wanted to. Mm-hmm. Or, I would say that he might do that, by the way, if he has a sense that the GOP is going to constantly be biting at him. Every candidate out there is talking negative about Trump to some extent. I mean, I don't think I've ever seen a primary campaign in political history where the lead candidate is the primary target of the other candidates. Usually it's the opposition party. So there could be a point where Trump says, heck with you guys, I'm going to start my own party. Now, why would he do that? Well, if you break the electorate into not half and half, but you break it into a third and a third and a third, then suddenly he might actually stand a better chance of winning a plurality of the popular vote than he would running as a GOP. Why? Because there's about 20% of the GOP that will not vote for him under any circumstance. They won't vote Democrat. They'll just stay home, or they'll vote for the other Republicans, but they won't vote for him on the presidential tablet. And he knows that. So I don't see how Trump could win the popular election with popular vote, because yes, he's got a huge block of the GOP, but he doesn't have that 20%. And you take 20% of the GOP and retire it. I don't know how you can win the popular vote, and therefore the electoral vote as well. So the GOP looks doomed to me in terms of winning the next election. Either whether he gets nominated or doesn't get nominated, it looks like it's doomed, because there's enough block to go either way to leave him. Okay. The Democrat Party is a wide open thing. We don't know who's going to get that. Biden may decide not to run, but still that's an open issue. But the notion that American politics is more divided than it's ever been is a true notion. But what's going to happen if the red states and the Trumpers don't win, or perceive even before the election they're not going to win? Do you think they're going to sit on their hands and say, oh, well, we'll wait to the next 4-year election? Or are they going to do something? Now, already they're doing something. Alaska just legitimized gold and silver as legal tender. Wow. Okay. Texas is moving toward a cryptocurrency backed by gold. Whoa. Those are near secessionist acts, where they're saying, hey, take your dollar and shove it, you central bankers and the federal government. We'll create our own currency backed by gold. In effect, that is a partial secession. Those type of events, including actual secession, there's many movements in the country right now to secede. There's some counties in Oregon, I think it's more than like 18 of them, that want to secede and go to Idaho because they don't like the politics of Western Oregon. Mm-hmm. There's even counties in Illinois seriously considering secession. There is a bill on the ballot in 2024 in Texas that says, if it gets passed, The state legislature must now seriously consider the possibility of becoming a separate nation, seceding from the U.S. No, it doesn't vote yes or no on that issue, but it votes on we must now have a serious discussion of it. Mm-hmm. Whoa. Yet this isn't being talked about on the financial channels. Something's going on here. And it could be 52 car pickup. And nobody's factoring it in to the markets. What does it mean? Well, it certainly doesn't mean normality. So there's another variable there. It could suddenly become a variable. Mm-hmm. It's there. I don't think there's any way out of it. I don't know any alternative to where it peacefully ends up just like another, Democrat, Republican. It doesn't end that way this time. Something's going to happen.
Mm-hmm. Yeah, I think you hit the nail on the head there. Thinking about this as a normal situation, whether we're talking about markets, interest rate regime right now, fiscal or monetary stimulus, politics, any of it is just, I think it's just such a hard picture to put together. But I appreciate your time helping us try to make some sense of it today, Michael.
Thank you, Tom.
Of course, you're available at olivermsa.com and on Twitter at Oliver_MSA, right?
Right.
Perfect.
And if you go to the website, you'll see my picture and my son and my daughter-in-law. And I have my email address. If you click on it, ask me, you get a sample report. Be happy to send it to you. Recent weekend report was quite interesting, I think. Mm-hmm. And no obligation. Just send me an email.
Perfect. Thanks so much for your time today, Michael.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.